Today we will discuss chapter 13, ratio analysis. A very important topic which will be useful for your A-level exam as well as for your future uh, courses that you learn in your degree programs, and if you are planning to do any other qualifications, this will be useful. So before we move on to the ratio analysis calculations, we need to understand some important concepts, important definitions, right? So the first thing is we need to know what is meant by a ratio. So if you see the definition of a ratio, it is simply a relationship between two variables. It's the relationship between two variables, right? If you take for an example, exchange rate. Exchange rate is a ratio, right? If you tell $1 is equals to 200 rupees. This is the ratio. It's a relationship. $1 equals to 200 rupees. Relationship between two variables. Right? One variable is dollar, other variable is rupees. And if you take, let's say, interest rate. In the bank, fixed deposit. If the interest rate, let's say it's 10%. So 10% is a ratio. It's the relationship between your investment and return. If you invest 100 rupee, you are getting 10 rupee as the interest. So it's relationship between two different variables, two different items. And this can be presented, expressed in different ways. Right? The ratio can be expressed. We can show the ratio mainly in three different ways. One is as a fraction, like 2/3, 1/4, right? Or else as a multiple, number of times, 5 times, 2 times, 3 times, or else as a percentage, like here. Okay, so there are different ways you can present the ratio, right? So next, what you need to know is, now earlier we talked about exchange rate, right? Bank interest rate. Now here in the syllabus, we mainly target on financial ratios. So what is mean by financial ratio? What is mean by financial ratio? Financial ratios are relationship between two financial determinants. Two financial determinants. So what are the financial determinants? Financial determinants are calculating ratios in the company financial statements, like in the income statement, statement of financial position. So we calculate the ratios for the financial statements. So in this chapter, we do the calculations for financial ratios. And we need to know why ratio analysis is important. The importance of ratios. Why it is important. Right? So from the ratio analysis, we can see the performance of the business. How does the business has performed? And profitability. You can see the profitability of the business. right? Then there are different users where they have different interest. So we need to provide different ratios for different users. Okay, and also we used to compare. The comparison can be either we can use the trend analysis or else cross-sectional analysis. What is trend analysis? It's very simple, where we compare our past ratios with the future ratios, present, past, and future. Trend analysis, and we forecast. Okay. Then cross-sectional means compare with other competitors for industry average. And so we can compare our ratio with our previous ratios, and we can forecast the future. We can compare with the competitor and the industry averages, right? Then the advantages and disadvantages, right? So when you look at the complete financial statement, it's very difficult to understand. From the first presentation, at first it's very difficult to understand if you have only the financial statement, income statement, and statement of financial position. But when you have ratio, it's very clear. You know what has happened previous year, what is the current year, what will be in future. It's easy to understand. It's very effective way to make decisions. Once you have the ratios, you can make your decision in an effective way. You can compare with your past data and you can analyze the future, right? So there are so many advantages. And also there are some disadvantages. Where ratios depend on the accuracy of information sources. If the information source is wrong, ratio is also wrong. And another disadvantage is based on the past ratios, if you analyze the future, sometimes there can be other factors which will affect the future. So you can't exactly 100% depend on the ratios when you make decisions. So right. So those are the theory parts. Now we'll move on to the calculations. Right. So when you talk about calculations of financial ratios, we have 5 types of financial ratios. There are 5 types of financial ratios. Number 1, profitability ratio. Number 2, liquidity. Number 3, efficiency ratio. Number 4, gearing ratio. And number 5, investor ratios. 5 investor ratios. So first 4 ratios are very important because from that mainly we get a lot of questions. Investor ratio, only few ratios will be checked in the exam. So let's understand what are these ratios. In simple terms, profitability ratios are used to determine the profit earning ability. What is the ability of earning profits? Profit earning ability, that is profitability ratio. Then liquidity ratio, liquidity means in the other term, the meaning of liquidity is how fast you can convert an asset into rupees and cents or else cash in hand. Let's say you have stock. So your inventory, to convert it to cash, how many days will it take? Or if you take the debtors, how many days it will take to convert the data into cash, right? So most liquid item, that means 100% liquid item in the income statement is cash in hand, right? Then lowest liquid asset in the business is land. So here, liquidity, we talk about short-term liabilities. Ability to pay short-term liability. That means from the current asset, we compare the current liabilities, short-term assets plus short-term liabilities. Right? Then the third one is efficiency ratios. Activity means efficiency. So from those ratios, we evaluate the efficiency of the business. And gearing ratio is mainly the equity capital and the debt capital, loan capital. Let me compare the equity capital with the debt capital. Investor ratio mainly to make investment decisions. So these are the 5 types of ratios: profitability, liquidity, efficiency, gearing, and investor ratios. Okay. So these are the ratios. Now, when it comes to profitability ratios, we divide the profitability ratio into 2 parts. We divide the profitability ratios into 2 parts. Right? Number 1 is based on sales. Other one is based on capital. Based on sales, based on capital. So based on sales, there are 3 main ratios: gross profit margin, operating profit margin, net profit margin. Okay. So we know what is meant by gross profit. Gross profit equals sales minus cost of sales. Operating profit means earnings before interest and tax. That is equals to earnings before interest and tax equals to profit before tax plus tax. Profit before interest and tax divided by sales. Net profit ratio is your net profit divided by the sales. Okay. Then the profitability based on capital. Mainly we have ROCE, return on capital employed. So what is meant by capital employed? Capital employed has 2 parts: equity capital and debt capital. Capital employed means it has 2 parts: equity capital and the debt capital. Right? So we need to know what comes under equity capital, what comes under debt capital. Okay. So equity capital means mainly the ordinary shareholders' stated capital, ordinary share capital and reserves. And also if you have any convertible preference shares, we consider under equity capital. Convertible to ordinary shares, convertible shares. And also we have under equity capital reserves, evaluation reserve, general reserve, retained earnings. So those are the things comes under equity capital. Everything else, all other long-term payables, bank loan, debt, mortgage loan and all, debt capital. Then we have return on shareholders fund, return on equity shareholders fund, and also we have return on total assets. Total assets. Right. Okay. So second one is liquidity. I'll go through fast because you have the tune with your. You can just go through. We will more focus on calculations and writing reports. equity ratio, current ratio, and quick ratio. In the current ratio, we divide the current assets by current liabilities. When it comes to quick ratio, these are the two ratios very important. Quick assets, what you do, we deduct the stock value. There's a question, so what is named as EBIT ratio? EBIT means EBIT equals earnings before income tax. Earnings before income, sorry, earnings before interest and tax. Write down this, guys. It means earnings before interest and tax. Sometimes we call the same thing as PBIT. It is equals to profit before interest and tax. We call it PBIT or EBIT. This is equals to profit before tax plus tax. Profit before tax plus tax. That's how we calculate it. In other words, let's say you have sales. Sales 400. The gross profit 600. Then other income, administration expense, selling and distribution expense, other expense, finance expense. Then answer will be profit before tax. Then tax will be after tax. Okay. So this is a draft income statement. Admin is 200, 100, 50, minus, let's make it 150. Finance expense and take it 100. So your profit before tax for this will be, gross profit is 600. Gross profit is 600. Then profit before tax is 150, 200, 400. Therefore, gross profit is 200. Profit before tax. If tax is 20, profit after tax and profit before tax is 200. Then if the tax is 20, this is 180. This is the basic income statement. So our question is, find out the profit before interest and tax. So since already we have the profit before tax, profit before tax is there. Profit before interest and tax means before paying finance expense. That is equals to 300. Some amount which goes here. 200 plus 100 is 300. Profit before interest and tax. Okay. Then we have activity ratios. Activity ratios we learn mainly for current assets and current liabilities. Mainly the stock, related to stock, related to debtors, creditors. Okay. These are the three main ratios that we calculate for activity or efficiency ratio. So stock turnover, average stock holdings. How many days we keep stock in the business. Then debtors turnover, average debtors collection, creditors turnover, average payment period. So we have those efficiency ratios. Then you have number 4, leverage. Leverage means it's like a lever. Right? You compare the capital of the business, debt capital and the equity capital. Debt and equity capital. Debt and equity capital. And also interest cover. How many times you can cover up the interest. Right? So these are main ratios. And you also have inventory ratio. I will discuss in the questions. Okay. Now what we'll do is we will do an example question. Right. So can you start doing this? One more thing before I move on to the question. As I said, this will be useful in many ways. That I will show you how I have used this ratio analysis for my analytical like reports. Okay. So this is a company I did. This is a company I did for an assignment, right? So what we do is we can calculate the ratios. Now this information we normally take from the company annual report. How much is the revenue? How much is the cost of sales? Right? All these values we take from the statement of income statement and statement of financial position. And these are from income statement and these are from financial position. So using this information, we are going to calculate the ratios. We can calculate the ratios. So you can see here, I have calculated profitability ratio based on sales, gross profit ratio, net profit ratio, operating profit ratio. So for each year, we can calculate and draw this bar chart. So when you are looking at the bar chart, it's easy for you to understand the company situation. What has happened to the company? Whether the profit has increased, whether the loss has decreased, items sold, and everything can be checked. And also you can compare your data with the competitor. Right? Okay. So let's do the example in the Qt. Okay, we'll start with example 1. Let's try to calculate as much as possible ratios from this. right? So the first ratio I'm going to do is net profit or gross profit ratio. So what is gross profit ratio? It is equals to gross profit over sales into 100%. Gross profit ratio is equals to gross profit divided by sales into 100%. So what is the gross profit here? So you can calculate for 2 years, then only you can compare 2012-13 and 11-12. So 2012-13 gross profit is 12,000. Then divide by sales 42,375. Then you will get a answer with the percentage. So 12,000 divided by 42,375 into 100%. 28.32. That is year 2012 and 13. And if you calculate 2011-12, the gross profit is 10,500. Divide by 38,000 into 100%. So if you calculate the answer, 10,500 divided by 38,000, 27.63%. Now by looking at these ratios, looking at these two answers, what can you tell? Can you all tell me? Looking at the profitability ratio, gross profit margin and gross profit over sales, what can you tell? I'm looking for answers. What can you tell about the gross profit margin? In 2011-12, previous year it's 27.63, 27%. Now it's 28.32. Right? So you can see it has increased. The ratio has increased. Now when you are writing, when you are doing an analysis, when you are writing a report, you have to say a few things. What has happened to the ratio? This is the most important part. Right? What has happened? Then you will say the gross profit margin has increased from 27.63 to 28.32 by, you can say the difference, 28.3 by 0.69%. Right? So you can see it's good. Having a higher gross profit margin is good for the company. Then you have to say why. What's the reason for this increase? What could be the reason? Can you all tell me some reasons? Why does the gross profit margin increases? What's the reason for an increase in gross profit margin. Sales has increased. Company has sold goods. That is wrong. When the company sell goods, that doesn't increase the gross profit margin. What else? Both sales and gross profit has increased. Yeah. Okay, so first we will understand how does ratio increase or decrease. Now here, for an increase in the gross profit margin, gross profit we have on the top and the denominator we have sales. For an increase in this ratio, your gross profit should increase. Then only the gross profit margin will increase. How does, right before that, what is mean by gross profit? Gross profit equals to sales minus cost of sales. Sales minus cost of sales. Then you need to see how does the sales is calculated. Sales is calculated quantity into price. Sales is calculated quantity into price. So how does the sales increase? You need to in depth go with the factors that affect the variable. How does the sales increase? Sales will increase if the quantity increases, or else the price should increase. Then only the sales value will increase. Okay. Right. So either quantity should increase or else the price should increase. Then for this increase, you need to assume that what has increased. So normally more than the price increase, quantity increase could be the reason. How does the quantity sales, number of units that you sell will increase? There can be many reasons, right? Either your marketing expenses increased, right? Or maybe due to any external environment situation. Due to any external environment situation, your number of units can increase. So when you are analyzing, when you are writing a report, or when you are analyzing the financial statement using ratios, you need to assume, or if it is for a real company, you need to see their company historical data and company's new improvements, and also the country situation, the environmental factors. For an example, let's say now because of this pandemic situation, some companies' income has increased. For example, let's say we had this Kapruka.com, right? If you analyze their gross profit margin, if you take the financial statements of Kapruka and analyze their gross profit margin for last year and this year, there is a huge increase in the gross profit margin. Right? It might be like, for an example, last year it might be, let's say 20%. This year it might be 40 to 50, maybe 60%. Right? So when you are analyzing, you have to say the gross profit margin has increased from 20% to 60%, and you need to tell the reason why it has happened. Reason is due to the pandemic situation. Most of the customers, they were trying to purchase through online, therefore the number of units has increased, and also the prices are also increased. Price also increased. So that's therefore the sales value has increased. Due to that, gross profit margin has increased. So you need to connect all these items, all these points. So then only you can provide a better description or explanation on the ratio. And not only this, for an increase in the gross profit is not only sales, you have another point, which is cost of sales. So either the sales should increase, or else your cost of sales should decrease. Right? Gross profit margin increases either because of sales increased, or else the cost of sales has decreased. Then you need to analyze and see why does the cost of sales has decreased. The main amount in the cost of sales is purchases, right? So you analyze the purchase cost. Why does the purchase cost decrease? Maybe you have got a discount. Maybe the inflation has reduced, right? Then also it may be due to any other environmental factor. That's how you analyze. Okay, or else your import duty taxes has been affected, or the VAT rate has been reduced. So there can be so many reasons. Right? So when you are writing the answer, you can assume that these are the things which has happened for a decrease or increase of these ratios. I was explaining the gross profit ratio. Okay, so let's move on to the next one. Then the second ratio, net profit. So you need to calculate for both 2011-12 and 12-13. So how do you calculate net profit ratio? 2011-12 net profit is 1,340 and sales is 38,000. So if you remember the ratio, you can remember the ratios, then it's only a matter of recording these values in the ratio. Okay, so that means 30,340 divided by 38,000 into 100%. Right? Then you will get the answer, net profit ratio. 1,340 divided by 38,000 into 100% is 3.526. So like this, you can calculate the ratio, the net profit ratio for 12-13. Now, very important, operating profit ratio. Now, tell me what is the operating profit ratio for 12-13. Just calculate and tell me for 12-13. operating profit ratio equals to operating profit divided by sales. How much is the operating profit? Tell me the answer. Operating profit ratio. Operating profit means profit before interest and tax. Now this is profit before tax. Before interest means you have to adjust the finance expense. Finance expense is interest, right? So operating profit equals to profit before tax 4,624 plus 495. That's the operating profit. Divide by sales 42,375 into 100%. That's how we calculate operating profit ratio. It's coming to around 4624 plus 295 12.08. Right, so that's how you calculate the operating profit ratio. Okay, so those are the three profitability ratios based on sales, right? So likewise, I want you all to do the example 1. Calculate all the ratios. Calculate all the ratios for example 1. Okay, then we'll move on. Let's try to do some MCQ questions related to ratios. Right. Give me 1 second. Right. So we'll do some past paper questions. MCQs. This is 2016. 16 August. Question number 21, 22 and 46 related to ratios. Right. So number 1. Which of the following would lead to reduction of net profit ratio of trading company in the current year compared to the previous year while the gross profit ratio remained constant? Gross profit is constant. Right. Normally what we have is, we have the gross profit. Then we add other income plus other income. Then minus all expenses. Then the answer is profit before tax. Then minus tax. Answer is profit after tax, or else the net profit. So here what they are saying is gross profit didn't change. No change in the gross profit. But the net profit has reduced. Net profit has reduced. Why does the net profit reduces? Net profit reduces if other income reduced, or else expenses may be increased, or tax may be increased. That's the reason net profit will decrease. Right? So net profit, in other words, net profit decreases if expenses increase, or else income decrease. Okay. Right. So can you all tell me the answer for this? Right. So let's check. Everybody, everyone try to answer. Three. Okay, I got answers. Right. So the current year's net realizable value of ending inventory being less than its cost. So if the NRV is less, what they're saying is NRV is less than the cost, then you recognize it as an expense. So because of this transaction, expense increase. So this is correct. Number one is correct. That if the NRV is less, net profit will be reduced. Right? It's another income. Sorry, it's another expense. Decrease in the interest income. Yeah, that's correct. If the other income, interest income is other income, it is becoming less. Then that is also correct. Revaluation of building at a deficit for the first time. So if you all can remember the PPE revaluation part, I did revaluation, initial revaluation and subsequent revaluation. If you have a loss in initial revaluation, that will be taken to other expenses. So this is correct. Other expenses increases. Right? Payment of an interim dividend of the ordinary shareholder. Where do you record payment of dividend? That is in the changes in equity, not in the income statement. So answer for this will be A, B and C only. A, B and C only, not D. Right? Okay. In the next question, the following information has been extracted from the income statement of a company. Right? Okay, so we have sales, profit, interest, expense, income tax, expense. But per the net profit ratio and the interest cover ratio for the year ending 31st March 2016. Just calculate and tell me. Here the answer, some issues with the answer. Just calculate and tell me the answer. What is the net profit ratio and what is the interest cover ratio? Thanks. How do we calculate net profit ratio? Net profit ratio equals net profit over sales into 100. Okay. So here the net profit is, profit for the year is net profit. Divide by sales is 4,000. Right? Then into 100. Into 100. And the answer is 200 divided by 4,000 into 100% is 5%. So that is correct. So most of you have given the correct answer for net profit ratio. What is interest coverage? Interest cover. So interest cover means from that what you are going to calculate is from the profit how many times you can cover up the interest. From the profit how many times you can cover up the interest expense. And what is the answer for that? Yeah, interest cover. So let's calculate interest cover, which is equals to profit before interest and tax, earnings before interest and tax, divide by interest expense. So our profit before interest and tax, which is equals to net profit plus the income tax 40 plus the interest expense 60. This is your profit before interest and tax. Because when you are calculating the net profit, we deduct interest expense and the income tax. So to get the profit before paying the interest, we should add the interest expense and the interest expense. Then this should be divided by the interest expense 60. So here the answer is 5. So net profit is 5%. Net profit ratio is 5%. Interest cover ratio is 5. Interest cover ratio is 5. Okay. Then next question. Next question. State whether an increase in the each of the following ratios will indicate an improvement in the liquidity of a company while other factors remain constant. While other factors remaining constant, they are asking whether an increase of each of the following. If we increase the debtors turnover, what happens to the liquidity of the company? Right. If the debtors turnover, what is mean by debtors turnover? How many times a debtor becomes sales? That is debtors turnover. If the debtor number of turnover of debtor increases, liquidity will increase. It is yes. Ability to pay your short-term debt will increase if there are more debtors turnover. If the debt collection period increases, debt collection period increases, there is no impact to the liquidity because cash, it will be recorded in the current asset anyway. If you have debtors, debtor is current asset. If you have converted it to cash, that is also current asset. So there is no impact for the liquidity. Liquidity will be same. Then the inventory turnover. Number of times an inventory becomes cost of sales. This inventory turnover. That will be yes. If you are selling more stock, your liquidity will increase. And retention period, no. Retention period increase doesn't impact the liquidity. What will impact the liquidity? Current asset and current liabilities. Other things will not affect the liquidity. Right? Collection period, retention period, that doesn't increase or decrease the current asset or current liability in the business. Okay, so that's the answer. Right. So we'll do the other ratio questions, MCQs. All right, we'll do one more. After that, I'll do a question from the second paper. So let's do this one. 2014. Use the following information of a company to answer question 23 and 24. Total assets are given. Stated ordinary share capital, retained earnings, and retained earnings year beginning and end 13 and 14. For the year ending 31st March, interim dividend paid to ordinary shareholders 1 million, interest on bank loan 125,000, income tax for the year 75,000. The profit to be used in calculating the return on equity ratio of the company. And the profit will be used. We need to calculate the profit. That's the answer. Right, so let's try to calculate. (2014), that is current year. That is return on equity, ROE. ROE. Return on equity means the return belongs to equity shareholders. Return belongs to equity shareholders. Right? So how much belongs to equity shareholders? If you calculate the net profit is equals to what? Right? Let me do what to do is I show you the statement of changes in equity. Right? So it has retained earnings. It has retained earnings. And we have the opening balance brought forward, and the net profit. And if you have any interim dividend, that will be deducted, and the balance carried down. So according to the question, our retained earnings at the beginning, it is 300,000, and year end it is 700,000. Beginning it is 300,000, year end it is 700,000. Right? And also there is an interim dividend paid to ordinary shareholders, which is 100,000. Now, how do you calculate the net profit? Right? So when you are going upwards, from down to up, whatever pluses we have to deduct, minuses we have to add. So 700 plus 100 is 800. 800 minus 300 is 500. So net profit belongs to the equity shareholders, will be 500. Right? Net profit belongs to equity shareholders will be 500 also. Okay. Then the return on total assets ratio based on the average total assets of the company. Return on total assets. What's the answer for this? Return on total assets. So you have total asset 100 closing 2,200. you need to get the average. And return for the average. Can I have the answers? It's how do you calculate return? Return on total assets ratio. So how do you calculate that far? So here we take return So we get average total assets 2200 plus 1800 divided by 2, which is 2000. So that's the average total assets. Then you need to get the profit before interest and tax. One second. So we take profit after tax. So they're asking us to calculate the total return on total assets. So how do you calculate return on total assets? It is earnings before interest and tax, EBIT, divided by average total assets. EBIT divided by average total assets. So what is EBIT? Earnings before interest and tax. So you have to calculate the earnings before interest and tax. So we have the profit after tax. Profit after tax is 500. Profit after tax is 500, right? Then the tax amount is given. Tax is given. Income tax for the year is 75. Income tax is 75. Then if you calculate profit before tax, which is equals to 575. 575. 575. And they have given interest on bank loans. So interest is also deducted. Interest is also deducted. How much? 120. Interest is also deducted 125. Therefore, profit earnings before interest and tax will be how much? 700. Right? So 700 plus 2. 700 divided by 2000. We're getting 35%. 35%. Okay, so we took earnings before interest and tax over the average total assets. Right. So we'll move on to a question from the second paper. We take the past paper question. Okay, let's see our past paper analysis. Right. Right. So we have. Okay. So here is the past paper analysis, ratio analysis in 2019, question number 6, right? Then in 2018, it was question number 6. 2017, question number 5. 2016, question 7. And 2015, also question number 5. So these are the questions that you all have to do, right? I will try to do some questions from this. Okay. Right. So we'll do 2017. Right. So let's do 2017. Okay. So I'll take the paper. Two 2017. Question number 5. Here it is. Right. So let's calculate the ratios. The following information relates to Mangala PLC for the year ending 31st March 2017. We have sales, profit after tax for the year, interest expense, and the tax. Then as at 31st March 17, balance sheet items are given. Total assets, PPE, inventory, trade receivables, cash. Total liabilities, trade payables, and the bank loan payable after 3 years. Additional information, trade receivables, 31st March 600,000. All the sales were made on credit basis. Required current ratio, debtors turnover ratio, return on equity ratio, interest cover ratio, and the asset turnover ratio based on year-end assets. Okay. So let's calculate the ratios for this. First ratio, the current ratio. So how do you calculate the current ratio? Current ratio is equals to current assets over current liabilities. Current assets and current liabilities. So how much is current assets? Current assets, what do you have current assets here? Inventory, trade receivables, and cash. These are current assets. So total 1,500. Current assets 1,500. Then current liabilities. Current liabilities, we have only the trade payables. Only this. Right? So that is 500. So if you divide this, here you have 3:1. That means to pay 1 rupee of liability, we have 3 rupee of current assets, cash, and other current assets. Right? So current ratio is 3:1. Current ratio is 3:1. Then the next question, they're asking us to calculate the debtors turnover ratio. So how do you calculate debtors turnover? How many times a debtor becomes sales, which is equals to credit sales divided by average debtors. Credit sales divided by average debtors. Right. So how do you calculate? What is the credit sales? Since they have not given any other details, total sales will be considered as credit sales. Total sales will be considered as credit sales. Then the average debtors. How do you calculate average debtors? Average means opening plus closing. Now, opening debtor balance is 600. Closing debtor balance is 800. Divide by 2. Opening plus closing divide by 2. Then that will give you the answer for debtors turnover. So 6,300 divided by 7. Answer is equal to 9 times. The meaning for the average, debtors turnover ratio is if the debtor becomes during the year, the debtor becomes sales 9 times. He purchased from us 9 times during the year, and it's an average debtors turnover. Then number 3, return on equity. Return on equity. Right? So how do you calculate return on equity? Return on equity equals profit after tax divided by equity. Profit after tax divided by equity into 100%. So what is profit after tax? Profit after tax is 1,200. divide by equity. Now, how do you calculate the equity? Equity equals, that's a simple way to calculate equity from this information. Total assets minus total liabilities. Total asset, how much do we have? We have 4,500. Total liabilities, we have 1,500. See here, this is total assets. Total asset. And here it's total liabilities. Right? Then how much is the answer? 1,200 divided by 3,000. 1,200 divided by 3,000 into 100%. This should be multiplied by 100, so you get 40%. Answer is 40%. Interest cover ratio. How many times you can cover the interest, cover up the interest? Interest cover. How do you calculate? Profit before tax plus interest. Profit after tax is 1,200. Profit before tax is 300. Profit before interest and tax, we will add the interest. So 600 is tax, 300 is interest. So you add, for the net profit, you add the taxation, and also we add the interest. And divide by interest expense. Interest expense is 300. So 1,200 plus 600 is 1,800. 2,100 divided by 300 is 7 times. Answer is 7 times. So we did interest cover. Asset turnover ratio based on year-end assets. Asset turnover. How many times an asset becomes sales, which is equals to sales over total assets. Sales over total asset. Sales value is 6,300. Sales value is 6,300. Total assets we have calculated earlier 4,500. So 6,300 divided by 4,500. 1.4 times. It means asset becomes sales 1.4 times during the year. Right? So that is question number 5. So what you do is, now I will give you some questions from the tube. So I want you all to do the questions and I will share the answers. Right. If there are any difficult questions, I will discuss. Right. So we'll do this question. After that, I'll give you some homework. This is a good question. Question number 5 from the tube which I sent. Extracts of the Statement of Comprehensive Income of Multichemi Exporters Private Limited for the years ended 31st March 2018, 31st March 2017, and 31st March 2016. Extracts of the Statement of Financial Position are as follows. So we have 3 years, 16, 17, 18. You may assume that the credit sales is 55% from the total turnover. Further, 90% of cost of sales consists of purchases, and out of that, 70% is on credit terms. Right? So we'll do this question. The requirements are gross profit ratio. You need to calculate for 18 and 17. Gross profit ratio. So I will do one, you can do the other one. I'll do 2018. I'm going to do 2018. Okay. Gross profit ratio equals 39,000 divided by 127,500 into 100%. So that's the gross profit ratio. $30.559 gross profit ratio. Gross profit over sales. Sales is turnover. And the net profit ratio, net profit over sales. Net profit means profit after tax, which is 8,020 divided by sales 127,500 into 100%. 8020 divided by 127,500 into 100%. Equals to 6.29%. 6.29%. Then we have quick asset ratio. So what is meant by quick asset? So we have current asset and quick asset. In the current asset, we take the total current assets. And you know, when you are calculating the liquidity, ability to pay your debt, if you have inventory, you can't pay the inventory. Right? Let's say you have the electricity bill, right? So you need to pay the electricity bill, but you don't have cash, you have the inventory. So can you pay through inventory? You can't. So it's not a quickly convertible asset into cash. Therefore, when calculating the quick asset ratio, we have to deduct the equity. Right? So quick asset means from the current asset, 20,470, we deduct the inventory 2,680 and divide by liabilities, 13,000 current liabilities, 2470 minus 2,680, 17,790, 13,200. Answer is 1.347. 1.35 times. Then they are asking us to calculate the debtors collection period. Debtors collection period equals shows how many days will it take to collect the debtors balances? Right? How many days will it take to collect money from the debtors? So how do you calculate that? So we calculate the average debtors divide by credit sales. Can you tell me the answer for this? So, six debtors credit sales into 365. How many days it takes to collect cash from the debtors? So we need to calculate the average debtors. What is average debtors? Trade receivables 15,460 plus 15,460 14,220 divide by credit sales. So there was a description regarding the credit sales. You may assume that 55% is credit sales. So total sales is 227,500. Out of this, only 55% is credit sales. So if you calculate the answer for this, 15,460 plus 14,220 equals 29,680. 29,680 and 127,500 into 55% is 70,125 into 365. So if you calculate the answer, 29,680 divided by 70,125 into 365, you are getting the answer 154. It's 154 days to collect money from the debtors. So there's a small mistake. I need to divide this by 2. Average debtors, it's 15,460. 15,460 again 14,220 divided by 2 is 14,840. 14,840. And this is 127,500 into 0.55. 70,125. Now if you calculate the answer, 48 divided by 70,125 into 365. 77 days. 77 days. So it takes 77 days to collect money from the debtors. Then the last one, creditor settlement period. So that is equals to average creditors divided by credit purchases. Into 360. So average creditors means opening plus closing divided by 2. Trade payable 6,400 opening, 6,100 closing divided by 2, 6,250. Credit purchasers, they have given an additional information. 90% of the cost of sales consists of purchases. So cost of sales is 88,500. Out of this, 90% is purchases. And out of this 90%, 70% is credit. So 88,500 into 90% into 7%, which is equals to 55,755 and multiply by 365. So the answer for this 6,250 divided by 55,759 into 365. 40.9 days. 40.9 days. Right. So that's how you do the calculation of ratio analysis. I will send you a list of questions for you all to do. So once we stop, you all start doing it. It will take another half an hour or 45 minutes. So within that time, try to do these questions and send me the answers. I will do the corrections. Okay. So I will stop the session for today. Please send me all a WhatsApp message, the number of question numbers that you all have to do. You all do it and send me the answer to WhatsApp. I will do the correction. So see you on our next class. Thank you.